When missiles fall, should investors run for cover? Welcome to Market Insight. I'm David Pollard. Oil prices climbed more than 3% on Wednesday as Israel and the US vowed retribution over Iran's biggest ever direct attack on Israel. But crude benchmarks then paired much of those gains, and while US stocks opened lower after Tuesday's sell-off, they then traded higher, with some market watchers saying the market fallout from the Middle East could have been far worse. So how should investors view the outlook? Well, to discuss that, I'm joined by Brian Crowers, President and Portfolio Manager at Scharf Investments. Welcome, Brian. Is the current geopolitical risk fully priced into the market, or are markets underreacting to the very big risks out there?
Yeah, currently the market's priced at about 22 times earnings. That's about the 10th percentile in terms of expensiveness. So the market is clearly very expensive. And it's facing a lot of not only geopolitical risks, but also political risks and recession risks. So we don't really think the geopolitical risks are fully priced into the market at this time.
Well, in that context, defence contractors are seeing strong bids. And in fact, you like Lockheed Martin, they are up 35% or so year to date already. You also like Occidental for different reasons as another possible play. Tell us about both of those.
Yeah, Lockheed Martin is the largest U.S. defense contractor. It's got a record backlog and history of consistent earnings growth, regardless of the economic backdrop. We think one of the potential risks of coming from geopolitical or political risk is a heightened risk of recession. Widening conflict is going to be disruptive to supply chains, global trade, investment, et cetera. So, we think investors should really focus on those companies can do well in any environment. Lockheed is just one example of that. Obviously they are involved in making the F-35 aircraft and the PAC-3 missile defense program. These are things that are going to be more in demand regardless of what happens with the economy. Occidental Petroleum is an interesting company in that they're highly leveraged to U.S. production. They're the market leader in the U.S. Permian Basin. So, when you have geopolitical risks and there's potential supply disruption risks from foreign oil, having a lot of the oil in the U.S. is a very critical asset. And so we like both of those as beneficiaries of what's currently going on in the Middle East.
And in these days of heightened ESG sensitivities, what ethical dilemmas are there for a US portfolio manager around investing in companies that potentially profit from conflict?
Yeah, we have a very involved ESG analysis framework that we use. And obviously investors have to gauge their own framework for what they want to use. From our lens, companies like Lockheed that are involved in defense are still, going to be companies that are okay to own as long as you don't have a whole portfolio full of them. And in our case, we look at a broader portfolio context in terms of its ethical impacts on the world.
Now, in your notes, you also touch on US election risk, and particularly a scenario where Donald Trump wins and does nothing to prevent China invading Taiwan. That's another hugely worrying scenario, but you say could provide a stealth AI play involving Samsung.
Yeah, the political risks are obviously very difficult to tell. We don't know who's going to win. And I would say, first of all, that history has shown that regardless of which president wins, things that really influence the market are much more important in terms of earnings, interest rates, and economic, outcomes. So fundamentals are really more important. But in terms of if, Trump were to win and, you had an issue in Taiwan, we think Samsung is a stealth way to play not only AI, but also if there were some geopolitical risks in Taiwan. It's one of the largest tech companies in the world, benefiting from long-term demand for memory. They just announced they developed a new high-speed bandwidth memory chip, and that's going to be critical as generative AI takes off. We see demand for their AI servers growing at 30 to 35% per year, at least over the next 5 years and for the foreseeable future. And yet the stock's trading at around 12 times earnings and just barely over book value. It's also got a ton of cash, so it's a very well capitalized company involved in a lot of parts of the tech ecosystem, and in part because it trades in South Korea, it just trades very cheaply.
So let's finish on the Fed outlook and what you see as the very real chance of a recession. Do you rule out the Fed being able to engineer a soft landing scenario in the US?
I wouldn't rule it out, but it seems right now that investors have sort of sky high confidence. They're really, convinced that we're going to have a soft landing. The truth of the matter is, soft landings are pretty rare, and so you have a market priced as if we're going to have a soft landing. But we think recession risks are reasonably high. If you look at the probability of U.S. recessions, particularly by the U.S. Treasury spread, it's saying about 65%. So obviously nobody knows, but with the Fed raising rates or cutting rates by 50 basis points, that has really got investors excited. And the truth of the matter is 10 out of the last 12 times the Fed raised rates by 50 basis points for its first cut, we had a recession.
Okay, Brian Crowers of Scharf Investments, many thanks for sharing your thoughts with us today. That is your market insight. You can watch more videos on Reuters.com.